In this module, we are going to discuss the need for a GST reconciliation. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, the call for a GST reconciliation began with a lawsuit called Bloor Italian Gifts. The company did not remit just a bit more than $1 million in provincial sales tax, retail sales tax, or provincial sales tax. And this happened between 1985 and 1991. There was a lawsuit, it was appealed again in 2000. Took rather a long time. And it was a review engagement, wasn't an audit. Now, in Bloor Italian Gifts, for instance, in the month of March 1988, and other months were similar, there were sales of just under $100,000. And the PST, provincial sales tax return, showed the tax, provincial sales tax of $51 was collected. Sales tax rate is 7%, it was at the time. 7% of $100,000 is $7,000. Materiality is often 2% of revenue. And seeing the other months were similar, we multiply each of those things by 12. We have found a material misstatement. Wasn't hard, pretty obvious. And PST is easier. A PST is easier because you just record the provincial sales tax on all sales. Normally, unless you have export sales or sales to another province. This company was based in Toronto and basically sold stuff in Toronto, so it paid Ontario provincial sales tax. So there were no investment tax credits that you had to deal with. And the judge said, with even a minimum of curiosity, you would have detected the mistake. So this wasn't hard, didn't need a GST reconciliation, didn't need a PST reconciliation. There it was, obvious material misstatement. Now, the accountant had done a quick analytical procedure in 1981 and 1982, and it worked, but didn't do it after that. And it's a little scary. Look how far lawyers go back to point out that you did it right once and then stopped doing it right. Now, the other thing the judge said was the tax bore no relationship to sales. And in the end, what the judge did, he quoted standards at the time for review engagements and said, make reasonable inquiries and comparisons, and you would have found the error. And the judge never suggested a reconciliation. But what happened was some people, based on this, concluded that you should always do a GST reconciliation in audits. And is that wrong? Well, there are no specific procedures required in professional standards for audits other than an inventory count. That's the only one. Everything else is about risk and material misstatement and professional judgment, design appropriate procedures. And anyway, the judge said, hey, if you had followed review standards, you would have found it. You did a quick analytical procedure and you would have found it. Reasonable inquiry and comparison would have found it in a review, and it would have found it in an audit. Now, you have to do something in both. Both require, we have a tax liability, we have to ask doing financial statements, giving an audit or a review engagement opinion, have to do something, just not necessarily a reconciliation. And the other question I have is, well, what about provincial sales tax? Do we have to do a PST reconciliation? How about employee deductions? That's a potential liability that we're supposed to be deducting and remitting. Do we have to do an employee deduction reconciliation, workers' comp rec, and so on and so forth? Now, the other question I have is, do GST reconciliations work? And if all sales are taxable, you have no zero-rated sales, you have no foreign sales, it's a simple client, If input tax credits are simple, we can predict them by looking at expense categories in the general ledger. Maybe. I've found, as a practical matter, as clients get more and more complex, they often do not work. You can't do it. Now, the other question I have is, are we just fixing our assumptions to make it work? So we assume 40% domestic sales, 30% zero-rated sales, 30% foreign sales. Oh, that doesn't work. 35% domestic sales, 42% zero. Oh, no, that doesn't work. Oh, and we got to fix our assumption on input tax credits. Okay, let's do this assumption, that assumption, this assumption, that assumption. Oh, good, it works. We have a GST reconciliation. We've got pretty documentation. We've made a whole mess of unsupported assumptions. It's a pretty documentation. We'll put it in the file. But if you look at it hard, it doesn't provide any evidence, audit or review. And the other thing I think I would say, if you don't understand the system in both an audit and a review, and you have to have some level of understanding of the system, more in an audit, less in a review, probably doesn't work unless you understand pretty specifically how it's done. The reconciliation probably doesn't work. So I don't like it for that reason. So a reconciliation is great documentation. It looks good in the file. People go ooh ah. But if you look at it hard, it's perhaps a poor audit test, and perhaps GST is still wrong. And the other thing about saying you must do a GST rec is, well, what about all the other similar year-end accruals? And something has to be done proportionate to risk of material misstatement on them as well. And I guess all I'm saying is there are lots of different tests available proportionate to risk of material misstatement other than a reconciliation. Now, as I said, you need to have an understanding, some level of understanding in an audit of how each of those different liabilities arises. You must assess risk of material misstatement by assertion, and if it's high, you got to do a lot of work, and if it's low, you just have to do a little bit of work. In an audit, we have to do risk assessment procedures. So if we're thinking about how GST or PST or employee deductions, how that liability is accrued, we'd need to learn something about that by doing risk assessment procedures. Maybe we look at some invoices for payroll. How do you do your payroll? Do you have a payroll service? That would answer the questions of how those different types of liabilities are accrued. And how is the return prepared? I suspect in a larger client, the client is going to say, look, we have three possible types of sales: taxable, zero-rated, and export. We very carefully note that on the invoice. When we send the invoice, we record each invoice in the general ledger. We do the same thing when we pay for things we purchased. We record the input tax credit in the general ledger account. We have two accounts, one called tax collected, one called input tax credits. At the end of each reporting period, we net the two and send the money in, because we have no way of analytically determining how that is done. We have to do it invoice by invoice by invoice. And maybe you can say, oh, well, around 30% are this type and 40% are that type, but that changes every month and it changes every year. So lots of clients are just going to say, hey, we rely that we do this correct invoice by invoice. Sales invoice, purchase invoice, we record it individually, we accumulate it, and that's how we determine our GST or PST. And we can't analytically prove it because it changes around too much. So audits are not procedural, they are risk-based. And if you take a procedural approach in an audit, it may be less efficient, probably will be less efficient, because you're just going to have to blanket things with procedures. If a procedure might be necessary in an audit, You have to do it in every audit. And staff will sooner or later figure that out, and they'll be annoyed, and they'll be saying, we're doing useless audit procedures, and that will have other impacts on staff. If you're just doing it procedurally and an unusual or new risk arises, you might miss it. And a procedural approach is not in accordance with standards. Assess risk of material misstatement, do risk assessment procedures. All of the things in standards that we're supposed to do are what we're supposed to do. We're not supposed to be doing them procedurally. We are supposed to be doing them on a risk basis. So in an audit, we got to be specific to each client. We've got many different procedures that we can use. There are lots. We will select the ones that make the most sense for our client. Now, maybe you can do a rec, and if it's a simple client and it's a well-done rec, it's 100% proof. We have nailed it absolutely. Now, that's too much evidence, perhaps. Even if risk is high, we don't need 100% proof. But if it takes you 5 minutes, like in Blue Italian Gifts, it took 5 minutes to conclude with 100% certainty that they were doing it way wrong. So, very simple test, 100% proof one way or the other. Now, a poorly done rec looks pretty, great documentation, fool yourself, fool other people, but it might in fact provide no proof at all. It might be a terrible audit procedure in terms of providing sufficient, appropriate audit evidence. Now in a review, not going to talk too much about that. We do inquiry and analytical procedures. We assess if material misstatement is likely. If it's not likely, we stop. Reviews are pretty simple. You still get an understanding of the accounting systems and records. You do that by inquiry. The procedures are inquiry and analytical procedures. And as the judge in Blue Italian Gifts said, the answer was obvious on the face of it. 30-second look, it was wrong. Now, what you did to solve the problem, I don't know, much more complicated. But that it was materially misstated, obvious in seconds. Now, one of the things that I thought I wanted to do as a result of Blue Italian Gifts made it clear that we were supposed to have asked the client had they done their returns right. So I would like to get a representation in the rep letter on both an audit and a review saying we have properly prepared and filed our GST, PST, employee deductions, worker compensation, and other such returns, because I want the client to explicitly tell me that and say that they've done it and they've done it correctly. Now, I think I also want the client to say we're not relying on you for the preparation or accuracy of the return, because we're telling you that we've done it properly and accurately. Now, I don't think that last part would have got you off the hook in Blue Italian Gifts, because it was so obvious that it was wrong. But I think I would like most clients to tell me that, and if it's a little bit wrong, they prepared it incorrectly and inaccurately, that they're not relying us to do an audit of their GST return or their employee deductions payable. They've done that themselves, and we will do audit procedures appropriate to risk of material misstatement. And if an immaterial or even a large error that wasn't found by our tests is there, I'd like the client to acknowledge that they're not coming after us. Now, there are lots of tests in audits that produce great documentation. It looks lovely in the file. But we know that they are poor tests. And we've got to watch it, because there is a real push for documentation in audit and review files. And there's a real push to produce pretty documentation that isn't in fact good audit or review evidence. So we got to watch that we're not falling prey to that and other people saying, oh, you should do this, you should do that, you should do the other. Well, they don't know anything about our client, anything about the audit, and unless professional standards tell us to do it, we don't have to. And I think a GST reconciliation may well be an example of pretty documentation that we're being encouraged to put in the file by other people, but it's in fact a poor test. So, thanks for listening.